Alright, so in this lesson we're going to be covering odds enhancers, the probability sheet, how to use the probability sheet, and then we're going to cover entries, exits, profits, stop losses at the end. Now that shouldn't take too much time, but people seem to think like that's the holy grail, that's where you make the money. It's really not, but we do have rules around it, how we take profits, where we place our stop loss, entries, and our exits. Well, I guess our exits is our profits. So it's really just entry profits and stop loss. So let's get into it. So each of these odds enhancers that we're going to go through each individually and discuss how they're used. It's very simple. It should only take us 10 minutes. And well, let's just get right into it. All right, so this is the first odds enhancer. It's called the strength of the move away. It's a visual gauge. No 50% candles allowed in this. This is just the strength of the move away. So this is the drop base rally we're going to be marking out and talking about. Drop base rally. And the strength of the move away is this right here. Is the move out right here. See how it's a strong move? It opens, comes up, it's strength, it closes very strong, and then it continues it up. There was no 50% candles. Like say this daily chart, for example. I wouldn't want to use this daily as a level because it's a 50% candle, and I always suggest using strong moves. That's telling us that the buyers or sellers took control. And this candle right here is a 50% candle. All right. So if you did want to use it, that would be called a medium strength away, and you would get a 1. I would really suggest looking for strong moves. That's why it's number 1 on our odds enhancer list, and it gets a score of 2. So we want to find strong moves away from the zone. So if we go back into our level, let's do, so if we know the strength, we'll do STR equals 2. So right now we know the strength is the 2. Because why? Big move out. It closed very strong. That's exactly what we want. We don't want weak candles. That's telling us that the supply or demand was not really in control and there wasn't a big stack there. The second one we want to determine is the distance it moved away before returning. This must be measured. At least 4 to 1 equals 3. A 3 to 1 move out equals 2. 2 to 1 equals 1, and less than 2 to 1 is 0. So this is the distance moved out before price returned. So this is the first time that price returned into this zone. And if we had to measure it, we will use this tool right here. There's I believe it's price date or price range. So the size of the zone is 11 pips. All right. So we need to see this thing go up. Let's see how far this thing go up. This thing went up 150 pips. This thing basically went 15 times the size of it. So that's a very good move. This price didn't return until it came all the way up here, and then it started to come back and return. So that right there, we would give it a score out of 3. Distance equals 3. So we measure that using that indicator I just talked about. Or you can find a way to measure it yourself. It's totally fine. But if it moves 4 to 1, we want to give it a score of 3. The farther it moves, the better it is. And freshness. The next one is freshness. Has price returned to the level since it was created? I always talk about fresh levels versus tested levels, and I always suggest totally fresh levels because that means that's the best chance for a winning trade, and it has the most amount of buy orders and sell orders still sitting in that. All right, so let's see if it's fresh. Prices never returned down into it before price here. So it was clearly fresh, so that will get a score of 2. Fresh equals 2. Right, is it 2? Yes. Now, if price did return, if we opened up the chart and we said, okay, we're going to be scoring this zone right now. Well, actually, we should be scoring it right now because we just opened it up. If we were to take this level, right, if price was like that, prices hasn't returned to it, it would be fresh, right? But as soon as that happened, and if we're deciding to score this based on now, if prices came back down into it, is it fresh? No, it's not. So Actually, this would get a score of 1 because it actually never penetrated 50% into the level. See how it came just in a bit and then respected it? So if we're scoring this based on right now where price is, it would get a freshness of 1 because prices has tested it, but it went less than 50% in. So if we're talking about 50% in, this zone is a total of basically 11 pips. We'll round it up to 12 pips. So prices had to, in order for it to go 50% or less, it could only go up to 6 pips, and then that would still qualify it as a score of 1, tested but less than 1. But if prices came down this far, it would get a score of 0 because it came in. Look how far it came in. So next time prices come in, do you really think it's that quality of a zone? No. So that's how we're going to discuss fresh. We'll leave fresh as 1 right now because technically it is tested, and if we're judging it based on now. But if you wanted to talk about this trade before that move happened, it would be a 2. All right. Next, we're going to talk about the time spent at the level. This is gauged on the time frame the zone was found on. So if you're looking to enter on the 1 hour or 4 hour chart, you gauge this based on the time zone you found the zone at. So your entry time frame. So typically we want 1 to 6 periods or 1 to 6 candles, and that will equal 1. And if it's more than 6 candles, it will equal 0. And this is a note: if the base consists of 1 candle, this can be viewed on a smaller time frame to assess the zone. All right, so if we go to the chart, we see 1, 2, 3. There's only 3 candles in here, so that gives it a score of, what is this one called? Time spent. We'll call it time equals 1. All right, so right now we're just scoring out the zones to see if it's quality or not. Next, we get into our curve time frame. All right, this is important. This is the relationship to the big picture and the trend in our secondary time frame. So if we have a demand zone low on the curve with our intermediate trend up, it's a score of 2 points. If we have a demand zone low on the curve with the trend down, it gets a score of 1 point. All right, so you guys can go through this and discuss it. It's really simple. If you have a supply zone high on the curve with the trend down, we'll get a score of 2 because you're high up and then you got the intermediate trend down. You should be looking for sells. That's exactly what you want. What you don't want is a supply zone in the middle of the curve with the trend up. So I talked about that. If we're going to be taking trades in the middle of the curve, between the 2 curves, and the trend's up, it's going to get a score of 0. You're basically asking yourself to lose. All right, so what we have here is a demand zone inside our 4-hour rally, base rally right here. So we know we are inside a big picture level, and I believe our 4-hour time frame is down. So our intermediate time frame, our trend time frame is down. So if we look up into it, demand zone low on the curve, we're low on the curve with the trend down, it's a score of 1 point. Okay. Curve equals 1. All right. Now we got to ask ourselves, this is the final one. This is an important one too. This will test us to see if it's a qualified supply or demand zone. Did the zone remove an opposing zone? Yes or no? This could be used also if it broke a momentum line, but removing an opposing zone is better. So if we go up to, did it remove an opposing zone? Yes, it actually removed supply here, and eventually remove this. So yes, it did. So let's go like this. Remove equals, yes, 1. So that's all we've done. So now we need to total up the scores Let's see, 3, 2, 5, 6, 7, 8, 9. So we got a 9 out of 11. What does that allow us to do? 9 or 11, we can place a limit order. That's perfect. Means we can take the set and forget trade. So it looks like we got 9 out of 11. That's okay. That's great. That would allow us to take a limit order. And if you score 7 to 8, you would need a number 2 or a number 3 entry, which is confirmation, right? Now these are also extra odds enhancers that I really enjoy using. You don't necessarily have to use them, but these are some of my favorites. Is the dollar index, which is the futures market versus the major currencies. You have Aussie USD and gold correlations, USD CAD and oil, US indexes and the bonds correlation, and I already said it is the futures currency index charts. So I really like to use those currency index charts. If you're going to use them, that's like going down into, what was this, USD CAD 1 hour. We go to the USD and we look at the 1 hour. Well, I don't really see any correlation in that. But if you can find levels that correlate with it, maybe let's see the CAD. So CAD had a correlation. It was coming up into the supply here. So that was the Canadian correlation. Canadian was coming up into supply, meaning we have a weak Canadian dollar. So that means the Canadian's going to fall and the US dollar is going to rise in that pair. Right? So here is the exact same level. So that would be a small correlation play. Alright, so now we're going to go score another zone just so you guys get it, and we're actually going to take the latest trade that I took. Alright, so we are on Euro USD, and I took this zone right here. So let's score it out. Now you guys should be doing this with me to be testing yourself. You guys could pause the video and actually go through this zone right now if you wanted to, and see what the quality is and see if you're getting the same results as me. So let's talk about it. First one, strength of the move away is a visual gauge, no 50% candles. Let's talk about it. Rally base drop, base drop. So yes, it's a strong move away. Very strong, no 50% candles. That's what we like to see. See, notice how it's a big strong one. It holds its selling position. It holds its strength. It didn't pull back, so that would give it a score of, hold on, STR equals 2. Next is distance moved away before a price came back into the zone. Well, it came down this far, so obviously it's a max score. So it was actually 10 pips, and it moved a total of 70 pips. So that's basically clearing the profit margin. So you could assume, not assume, but take a good chance that prices will go all the way back down to this original spot because it just cleared all the demand orders till down here. So we have a distance move of 2. We need to talk about freshness. Distance equals 3. Sorry, 3 distance. Fresh equals, is it fresh? Was prices before price came up into the zone, was it fresh? Prices never came back into it, so yes, it was fresh. It will get a score of 2. Right? Score of 2. Yes, price never returned into it. Time spent at the level gauged on the same time frame was found, 1 to 6 periods. Yes, so I found this on the 1 hour. This is a note. If it's one candle, you can go down into the 30-minute or like one time frame below it and see how many candles it is, but it's really just going to be 2 or 3. So we can change that to candles equals 1, I believe. Time spent. Oh, my bad. Time right, now we go down to curve. We did a supply zone, so are we supply zone high on the curve with the trend down? All right, let's see. This was a daily setup, sitting in daily supply, so we know we're in daily supply. What is the secondary time frame? It was sideways. Why? Because we removed this rally-based rally. We couldn't draw a downward momentum line yet. So we were clearly sideways, which would give us a score of, let's see. Let's just get back in here. We have a supply zone high on the curve with the trend down. No, we don't have that. We have a supply zone. We have a supply zone high on the curve with the trend up. It's not up, but we don't have an option for sideways. So it's just going to get 1 point anyways. If you want, you could go 1.5, but it's really not going to make too much of a difference. Curve equals 1. I don't want to use 0.5s. And now we got to ask ourselves, did it remove an opposing zone? Did it remove an opposing zone? Yes, it did. It removed this rally, this drop-based rally, and it broke that upward momentum line, right? So if we actually drew that upward momentum line, we busted it, so it gave us that extra confidence too. Remove / break equals 1. And now if we were to total this up, we have 3, 5, 6, 7, 8, 9, 10. We have 10. And now we had 10 out of 11. That would give us the ability to do a limit. That's a good trade. We want to score those high trades. Alright, and if we were curious to see if we actually had a futures correlation or any other correlation, let's see. Well, let's go see. When was this level came back and touched it? August, what is this, 19th? No, August 7th. It's not even August 10th. It's not even August 11th yet. So we need to find USD and go back to that date. August 7th. So here was the level. Here was that 1 hour level that price came back down into. So we had a futures correlation too, which is an extra bonus. All right, we could even see the euro to see if the euro had this exact same setup. And what do you know, it's the same thing. So the US dollar and the euro had that same one. Notice how the CAD and how the US dollar didn't have it with the CAD, but the CAD had that same level. This is a chance where a scenario where both had it, so it's like a good correlations play. That's why I really liked it. So that would be an extra odds enhancer, right? But that pretty much wraps up the odds enhancer sheet. This is going to be used for your entry time frame. It could also be used to determine the quality of the curve time frame. It's not needed, but we really want to make sure we're using this zone assessment for our entry time frames to pinpoint the zone exactly and to see how good the zone is, or if we should wait to enter on another chart, or maybe wait for another confirmation setup. It's really important to use this sheet right here, because this will keep you out of a lot of trouble. And for me, it's going to take time to actually score the zones, because you guys are going to have to go through this one at a time. Strength of the move away. Is it 2? Is it 1? Then go to the next. Once you get good, you're going to be bombing through this. Like, I could determine the score of these levels within, honestly, a second. You just know what they are. You know what you need to look for. Curve. I don't look for trades unless they're inside my curve personally, so I know that it's always going to be at least a 1. Time spent, that's important, because we don't want too many candles being formed inside our level. That's telling us that prices sat there for so many periods of time, and if it's been sitting there and going sideways for a long time, is there really an imbalance there? So if we actually try to find an example, so if we were to say, like, oh, I like this zone right here. Well, like, look how many candles this went sideways for. It's really not the best setup to be selling at, because it went sideways for about 10, 20 candles. So we want to be looking for those 1 to 6 candles in a zone. That will tell us the quality of, or how much time was spent there. Freshness, we want to make sure that zones are fresh, totally fresh. 1 return, 50% or less is 1. Distance move away, this is very important, telling us the profit margin, how far it moved before it came back. That's an important one. And then the most important is the strength of the move away. All right. All right, so that's what we're going to cover on the odds and probability sheets. Now we're going to talk about the entries, exits, profit, stop losses. All right. So first we're going to be talking about entry, then we'll go into stops, then targets. Shouldn't take too much time. So our entry, when we're buying, the entry line is at our proximal line plus the spread. So let's just say we were buying right here. We know how to draw the zones. We hug the base. We go to the bottom of the candle for demand. And that's exactly where our entry would be, is at the proximal line. All right, so if we're buying, it needs to be right here plus the spread. So if the spread is like 2 pips, it's going to have to be 2 pips above. That way we want to make sure that we're getting filled when price comes and touches it, because when we're buying, we're going to have to clear the spread. So when we're selling, we need to use the entry line at the proximal line plus the spread. And this is very important when we're entering, is location, location, location. We don't want to be buying when we're sitting in supply, and we can't be selling when we're in demand. It goes for every time frame. We never should be sitting in an opposing supply or demand zone. And another important thing, if there's no profit margin, there is no trade. We do not want price coming into the zone, basing and creating new supply or demand levels right before the zone. That's never a good idea. Notice how price came up into this zone. So this was my entry. We talked about it going over the odds. This is my entry. There was no demand zone till down here. So that was a good profit margin. Price came straight up into it. That's what we want. We don't want prices coming up into it and basing right before it and creating that new base, because like we talked about in lesson 1, the base is the army. It's setting up for the attack, and we don't want continuation patterns basing right before our zone. That's never a good idea. So if there's no profit margin, no trade. And we need to remember location, location, location. So if we're going to be selling here, we need to make sure our entry, our sell position is on the proximal line, and then our spread will have to be accounted for at the distal line too, because usually the spread's a bit bigger, and we might actually get kicked out of our trade. So we need to have that buffer room on top for supply, and then for demand we need to have it a little buffer room to get into it, because we actually have to clear the whole bid and the ask spread, right? Now for stops are it's that simple for entry. It's very simple. We know how to draw them. We draw them the same as we've always been drawing them. Now for stops, there's 2 types of stops. There are volatility-based stops, and for entry time frames less than or equal to 60 minutes, we're going to use 2% of the 14-day average true range. So we're actually going to go up into our indicators list. That's why you see sometimes my indicator has ATR, average true range. And what this is just going to tell us, it's just going to tell us the past 14 days of the average true range. And we want to make sure we're using the daily time frame. It says right here, use daily candle for measurement. So what we're going to do is we're going to go to the daily candle. Let me quickly move that. And we need to use the candle before the current day. So let's just say I entered on this candle right here. Say this candle was still moving. It was still live, so we don't want to use the active live candle because we don't know how it's going to close. We want to use the 1 day before it closed. So we want to use this candle right here. And we're going to go down to our 14-day average true range. It's just going to tell us how many pips it averages. That's right. That's why we're going to have the 14-day average true range. So it averages out to be 57 pips a day right now. So if we go back into our picture, let me just line this back up again. So we need to find the 14-day average true range. We know that's 57, and then we need to use the 2% of the 14-day. So 2%, that should be like less than 2 pips. I'm pretty sure it should be less than 2 pips. You could do the math. You could just Google it. But This is a rule now. I should have this added. I'm going to add this right now. But we need always a minimum of 4 pips. If it's less than 4 pips, like it is here, we need to make sure we use a minimum of 4 pips every single time just because of that spread. We don't use 1.2. If it's 4.5, we round it up to 5. But the minimum's always going to have to be 4 pips, okay? So let's just say, let me adjust this. Let's see. Minimum equals 4 pips. Just added it like that. So the minimum has to be 4 pips. And now the other way to do stops is if we're using a 4-hour, if we're using 60-minute plus over the 60-minute time frame, so say the 4-hour, we need to use 10% of the 14-day average true range. And we use the daily candle for measurement. Same thing, we go to the daily time frame, we check out the measurement, we see it was 57, and we need to find the 10% of the average true range, which in that case, of 57, it would be 5.7. So we'll round it up to 6. So we need to make sure that our stop, let me just line this up. Our stop would have to be 6 pips. So if this was a 4-hour time frame, just say 4-hour daily, weekly, monthly, it will have to be 6 pips for that. Now if it was for a volatility based stop of 2% and we didn't have that, have 4 pips, we had 1.4, we would need to use 4 pips minimum. Alright, so that's one base stop, is volatility based stop. That's a very easy concept. And then the other stop is called structural stops. And we basically just go set stops above or below previous closest structured supply or demand. So if we actually look at this demand, we need to see, okay, are we going to use structural or volatility based? Well, structural would be like, say if we were entering short right here. Say we were trying to get this pullback right here. We're going to mark this out. Let's just say we were selling that, and our pips, or our stop loss, was going to be 4 pips. In this case, we would want to use a structural stop. We want to be above this structure. So we would want our stop to be like just around there, above it. There's no set in stone way to do stops. We need to really eyeball it, engage what's best for it, and there's no right or wrong answer. And then the same thing for this demand zone. We're going to use probably a structural stop, not a structural, but a volatility-based stop, because there is no structure down here. Right? There's no lower high, higher low. There's nothing like that. So we need to, and there's no demand zone till lower down here. So we need to use a volatility-based stop. So our stop will be 4 pips, something like that. It will be stop loss, entry, and then that's how it's going to work. All right. So that basically covers like the entry, stops. It's really that simple. We're going to use volatility based. If we're using 60 minutes or below time frame, so 30 minutes, 15 minutes, 5 minutes, then we need to make sure we use the 2% of the 14-day average true range of the daily candle that closed. And if we're going to be using above the 60 minutes, say the 4-hour or plus, we need to use 10%. That's just going to give us the volatility-based stop. And if we want the structural-based stop, well, then we got to look for structure above or below current price. We just covered those. Now for targets, we do you can either do all in, all out. There's many ways to actually cover targets. It really depends on the type of trader. Maybe you're a trader that likes to do higher lows, lower highs, stuff like that, and follow the structure. But when it comes to our first target, we want to make sure that we're getting out at our entry time frame closest fresh opposing supply or demand zone. So when I took this short, I was looking to get out before this. We had a rally-based rally. That was the next fresh demand zone. So I wanted to get out right before this. So I got out right before this level right here. So my first target is always going to be on my entry level time frame, closest fresh opposing supply or demand zone. I said that pretty clear, and that's how it's going to work for pretty much every target on the first time frame. We want to make sure we're getting out at the next closest supply or demand zone on our entry time frame. You guys understand that? And then if you want to take a secondary target, which what I do, I'll go up a time frame and I'll use my secondary time frame and I'll put that second target at the opposing next higher time frame up supply or demand zone. So maybe if I go to the 4 hour, and let me quickly move this. I don't see demand till down here, so maybe I'll have my secondary target down here. But if it's really like a 21 or 30, or like say it's not till like 10, 15 to 1, well then if you really want, you could get out at like a 7 to 1 or something like that. But it's really up to you. You're gonna have to base this based on how you like to run things. I can't tell you how to take profits and why you should take it there. I could tell you where you might want to be looking to get it out, as in fresh closest supply or demand zones, but it's really up to you how you want to manage it, and everyone's going to be different with this. Then you've got to ask yourself, how are you going to manage your stop loss? Are you the type of trader that doesn't like to lose? So you want to get out after, you want to protect your stop loss after prices move 2 to 1 or after it's hit your first target. For me personally, I like to get out. I like to move my stops right now, currently, after 1 to 1, just because based on, I think it's how I was growing up, what my beliefs are in the market. I don't like to see prices go 2 to 1 in my favor and then come back and stop me out for a full loss. I'd rather personally have it where it just goes 1 to 1, 1.5 to 1. I get my first target, and then I'm letting my other target ride. And then I don't mind if it comes back and stops me out, because maybe it's based on I'm a sporty guy. I enjoy my sports. I've been on some really horrible sports teams, and I've been on some really, really good top-end sports teams. I used to be like a competitive player online. We were on winning teams, and we would go on crazy win streaks. So I think it's just embedded with me that I like to win, and I like to protect that win. So I don't mind getting that 1.5, 2 to 1, and getting out. As for someone else, you might only like going 1 to 1 and getting out totally, or maybe you like to take that multiple time frame analysis or that multiple time frame target system. Maybe you like to manage your stop after it goes 2 to 1, 3 to 1, and then maybe you've got to ask yourself, are you gonna continue how are you gonna manage that stop? Are you just gonna have it a trailing stop at 20 pips, or are you gonna use structure? So let's just say you got short right here. Price came down, up, down. Are you going to have your stop loss like 20 pips continuing down, or are you going to use the structure as a supply zone? Right? That's what you got to ask yourself. So it's really going to depend on you, but it's really important that you guys remain consistent with that and do it again and again and again. Not one trade, move it at 2 to 1. Second trade, move it at 1 to 1, and the next trade you don't move it. Right? So you guys are going to have to base this based on your pros, cons, your beliefs, and your emotions, right? And you have more fear-based or greed-based trader. I'm personally more of a fear-based trader. I don't mind missing trade setups because I know there'll be more. But I hate when prices come back and lose against me, so I'm more fear-based. Right? I hate losing. I hate it. So, but some people are just more greedy. They don't mind losing, but they're super greedy, and the greediness gets to them. But that's really what we just wanted to talk about this. So in this one, we talked about the odds enhancers. You guys have that sheet. It's a very good sheet. Go through it. You can score any zone you want. We went through entries, exits, stop losses. It's really up to you guys about how you want to run it. I can't tell you how to run it. You've got to be hard on yourself to make sure that you're actually running it like how you should be. All right, you've got to take ownership. You've got to take accountability for yourself, because this is a solo game. We're in the chat room talking to each other. We're there for each other to help each other and talk about setups and questions that you might have and meetings. But at the end of the day, you got to perform for yourself, right? So it really depends on you, and I'm probably going to make a another video just putting it all together, a quick 5-minute video just wrapping things up, and then we're going to have a bonus video too at the end of it of just what the meeting looks like, what we're going to be talking about, it's going to be like a more in-depth meeting. All right, so I'll let you go with that. You guys should have the odds enhancers and the entries and all that, and now your homework to put in the homework tab is going to be send me 3 charts of you scoring a zone. Doesn't have to be in a higher time frame zone. It could just be like you go to this chart and you score this. You could go to any time frame, any chart, and just score a level. You could score this. You could score this. If you want, you could score this. You score anything, just you have the odds enhancer sheet, use it, and I'll tell you if you're right or wrong, or I'll adjust anything that you need help with. All right. So that's your homework. Is just send in 3 charts of the odds enhancers, of the scores of strength of the move away, the curve, time spent, distance, did it remove, all that. Put some notes on the page. Don't just send me a blank chart with 9 out of 10, right? Like, do some effort, and I'll put some effort into it too, right? All right, thanks guys. See you soon. Bye.